Welcome. Today we'll explore the world of accounting documents and journal entries. Every business, big or small, relies on accurate records to track financial activities. These records start with accounting documents, which serve as legal proof for every transaction. Whether you're buying a computer or paying rent, there's always a document behind it. These documents are the foundation for entering transactions into the books of accounts. Let's dive into why these documents are so important and how they set the stage for proper bookkeeping. Accounting documents aren't just paperwork, they're essential for recording all business transactions. They ensure that every entry in the books is backed by reliable evidence, making your records trustworthy and legally sound. These documents can be stored physically or digitally, and they're often required for audits, legal matters, and even government payments. Without them, it would be impossible to verify transactions or resolve disputes. That's why every accountant checks the authenticity of documents before making entries. Let's look at the main types of accounting documents used in business. Vouchers, invoices, receipts, and checks are just a few examples. Each serves a specific purpose. Vouchers support payments, invoices detail sales or purchases, receipts acknowledge payments, and checks facilitate bank transactions. These documents can be internal, like a taxi fare voucher, or external, like a tax invoice from a supplier. Understanding these types helps you organize and record transactions efficiently. Vouchers are crucial documents in accounting. Internal vouchers are created within the business, such as a voucher for taxi fare when no external receipt is available. External vouchers, on the other hand, are received from outside parties, like a tax invoice from a supplier or an electricity bill. Both types serve as proof of transactions and are necessary for accurate record keeping. By distinguishing between internal and external vouchers, businesses can ensure every transaction is properly documented. Journal voucher is the basic document for recording transactions in the journal book. It typically includes details like the name of the firm, voucher number, date, debit and credit accounts, amount, and signatures for approval. This standardized format ensures consistency and clarity in recording entries. By using a journal voucher, accountants can trace each transaction back to its source, making audits and reviews much easier. Cash voucher serves as evidence of cash payments or receipts. Whenever cash is spent or received, a voucher is prepared. If you receive a document from the payee, that can also serve as a voucher. These documents are attached to the cash book and form the basis for cash entries. Cash vouchers help maintain transparency and prevent errors or fraud in cash transactions. Tax invoices prepared by the seller to inform the buyer about the goods supplied, rates, discounts, and taxes like CGST and SGST. It's called a purchase invoice for the buyer and a sales invoice for the seller. Tax invoices are essential for making entries in purchase and sales books. They also include bank details and other important information, ensuring both parties have a clear record of the transaction. Credit memo, also known as an invoice or bill, is issued when goods are sold on credit. It provides details of the goods sold and the amount due from the customer. Receipts, on the other hand, are prepared when payment is received, acknowledging the transaction. Both documents are vital for maintaining accurate records and ensuring that payments and dues are properly tracked. Checks are common tools for business payments. A check is a written order from an account holder to a bank, instructing it to pay a specified sum to a person or bearer. There are three parties involved: the drawer who writes the check, the drawee the bank, and the payee the recipient. Checks come in various types, including bearer, order, and cross checks, each serving different purposes and offering varying levels of security. Error checks can be cashed by anyone holding the check, while order checks are payable to a specific person or their order. Cross checks, marked with two parallel lines, must be deposited into a bank account and can't be cashed directly. Crossed account payee checks go a step further, ensuring the amount is credited only to the specified account. These distinctions help businesses manage payments securely. Now let's turn to the journal, the book of original entry. Every business records daily transactions in the journal, making it a vital part of bookkeeping. The journal helps classify and sort transactions for later entry into the ledger. Each entry includes the date, accounts involved, amounts, and a brief narration. By recording transactions chronologically, the journal ensures nothing is missed and every event is documented. Word journal comes from the French word jour, meaning day. A journal is a daily record of business transactions, capturing both debit and credit aspects as they occur. According to experts, it's a book used to classify transactions for easy entry into the ledger. The journal is also called the book of original or prime entry, as it's the first place transactions are recorded before being posted elsewhere. Journal is the principal book of account, containing all types of business accounts. It provides detailed, date-wise records, making it easy to track when events occurred. The journal's format with debit and credit entries and narrations helps prevent errors and ensures clarity. It's essential for preparing final accounts and checking the accuracy of transactions, making it a cornerstone of reliable bookkeeping. Typical journal format includes columns for the date, particulars, ledger folio, debit amount, and credit amount. The particulars column records the accounts involved, with the debited account listed first, followed by the credited account. A brief narration explains the transaction. This structured approach ensures every entry is clear, traceable, and ready for posting to the ledger. Journalizing is the process of recording transactions in the journal. It starts by identifying the accounts involved and their types. Next, apply the rules of debit and credit to determine which account to debit and which to credit. Record the date, write the accounts in the particulars column, and include the amounts. Finally, add a brief narration and reference the ledger folio for easy tracking. This systematic process keeps your records organized and accurate. Every transaction starts with a source document like an invoice or receipt. From there, the transaction is analyzed to identify the accounts affected and their classification. The dual effect, debit and credit, is determined, and the transaction is recorded in the journal. This process ensures that every business event is captured from its origin to its final entry in the books. GST, or Goods and Services Tax, replaced a variety of previous taxes in India, creating a unified system. Introduced in July 2017, GST applies to both goods and services with different rates for different categories. Essential items may be zero-rated, while luxury goods attract higher rates. GST is recorded in tax invoices and affects how journal entries are made for purchases and sale. GST rates vary: 0% for essentials, 5% for common items, 12% and 18% for standard goods, and 28% for luxury items. For example, if you buy a laptop for 50,000 at 18% GST, you'll pay Rupee 500 each for CGST and SGST, totaling Rupee 59,000. Journal entries must reflect these taxes, ensuring accurate accounting and compliance with regulation. In recording journal entries involving GST, it's important to separate the base amount from the tax components. For purchases, debit the asset and input GST accounts and credit the payment account. For sales, credit the output GST accounts along with the sales account. This approach ensures that GST is tracked correctly for both input and output, making tax filing and reconciliation straightforward. Term goods refers to items bought for resale. Purchases can be made in cash or on credit. Cash purchases involve immediate payment, while credit purchases allow payment at a later date. Each type requires a different journal entry, but both must be supported by proper documents. Understanding these distinctions helps maintain accurate records and manage cash flow effectively. Sometimes, goods purchased need to be returned due to issues like poor quality, damage, or excess quantity. These returns are recorded as return outward or purchase return. Proper documentation and accurate journal entries ensure that inventory and accounts reflect the true state of business transactions, helping avoid discrepancies. Sales are the core of any business. They can be cash sales where payment is received immediately or credit sales where payment is due later. Each type of sale is recorded differently in the journal, but both require supporting documents like invoices or receipts. Accurate sales records are essential for tracking revenue and managing customer accounts. When customers return goods, it's recorded as return inward or sales return. This could be due to defects, wrong items, or other reasons. Properly recording sales returns ensures that revenue figures are accurate and customer accounts are up to date. It also helps businesses identify recurring issues and improve their processes. Sometimes, the business owner may withdraw goods for personal use. In such cases, the drawings account is debited, and the goods withdrawn by proprietor or purchases account is credited. This ensures that business resources used for personal purposes are properly accounted for, maintaining the integrity of financial statements. Businesses often distribute goods as free samples for advertising. In such cases, the advertisement account is debited, and the goods distributed as free sample or purchases account is credited. This entry ensures that promotional expenses are recorded correctly and inventory is adjusted accordingly. If goods are destroyed by fire or accident, it's a physical loss for the business. The loss by fire account is debited, and the goods destroyed by fire or purchases account is credited. If the goods are insured, the insurance company account is debited for the claim amount. Properly recording such losses is crucial for accurate financial reporting and insurance claims. Goods can sometimes be damaged or lost while being transported to the buyer. In such cases, the loss in transit account is debited, and the goods lost in transit or purchases account is credited. If the goods are insured, the insurance company account is debited for the claim amount. These entries help businesses track losses and recover costs where possible. If goods are stolen or lost due to theft, the loss by theft account is debited, and the goods lost or purchases account is credited. Recording such losses helps businesses assess risks, improve security, and ensure that financial statements reflect the true state of assets. A simple journal entry affects only two accounts: one is debited and the other is credited. For example, starting a business with cash involves debiting the cash account and crediting the capital account. Simple entries are straightforward and form the basis for more complex transactions. Compound or combined journal entries involve more than two accounts. For instance, starting a business with cash, goods, and a laptop would require debiting each asset account and crediting the capital account. Compound entries simplify recording multiple related transactions in a single entry, making bookkeeping more efficient. Trade discounts are reductions given on the list price of goods, usually not recorded in the books. Cash discounts, however, are concessions for prompt payment and are always recorded. Understanding the difference ensures that only relevant discounts are reflected in your accounts, maintaining accuracy in profit calculations. When goods are bought with a trade discount, only the net amount is recorded in the journal. For example, if goods worth Rupee 20,000 are bought at a 10% trade discount, the entry is made for Rupee 18,000. This approach keeps your accounts clean and avoids overstating expenses or revenues. Cash discounts are recorded as they represent actual financial gains or losses. When cash is received and a discount is allowed, the cash account and discount allowed account are debited and the customer's account is credited. This ensures that both the cash inflow and the discount expense are properly tracked. Sometimes, a single transaction affects multiple accounts. For example, selling goods to a customer who pays part in cash and part on credit. Instead of making separate entries, a combined entry debits cash and the customer's account and credits sales. This method streamlines bookkeeping and reduces repetitive work. Expenses like wages, rent, or salaries are recorded by debiting the relevant expense account and crediting cash or bank. This reflects the outflow of resources and ensures that all business costs are captured in the accounts, supporting accurate profit calculations. Income such as commission or rent received is recorded by debiting cash or bank and crediting the relevant income account. This ensures that all sources of revenue are properly tracked, supporting financial analysis and reporting. When assets like computers or furniture are purchased, the asset account is debited and cash or bank is credited. If GST applies, input GST accounts are also debited. This entry ensures that new assets are added to the balance sheet and tax credits are tracked. Depositing or withdrawing cash from the bank involves debiting or crediting the bank account accordingly. These entries keep your cash and bank balances accurate, supporting cash flow management and bank reconciliation. When a loan is taken, the cash or bank account is debited and the loan account is credited. This entry records the inflow of funds and the obligation to repay, ensuring that liabilities are accurately reflected in the accounts. If an amount previously written off as bad debt is recovered, the cash account is debited and the bad debts recovered account is credited. This entry ensures that unexpected income is properly recorded, improving the accuracy of profit calculations. Outstanding expenses like unpaid wages are recorded by debiting the expense account and crediting an outstanding expenses account. This ensures that all liabilities are captured, even if payment hasn't been made yet, supporting accurate financial statements. Tax invoice specimen includes seller and buyer details, invoice number, date, description of goods, HSN code, quantity, rate, taxable amount, CGST, SGST, total amount, and bank details. This format ensures all necessary information is captured for both accounting and tax purposes. A receipt specimen records the payer's name, amount received, payment method, date, and purpose. It's signed by the receiver and may include a stamp for authenticity. Receipts are essential for acknowledging payments and supporting cash book entries. A cross-check specimen includes the bank's name, date, payee, amount in words and figures, account number, IFSC code, and the drawer's signature. Two parallel lines indicate it must be deposited into a bank account, adding a layer of security to the transaction. Cash voucher specimen lists the payee, amount, date, purpose, and signatures of the preparer, approver, and receiver. It may also include a GST number if applicable. Cash vouchers are attached to the cash book and serve as proof for all cash transactions, ensuring transparency and accountability.